friends. Great to see you once again. And I'm here with the stellar panel, must say. And we are going to unleash the potential of collaboration. I think without collaboration, specifically the financial institutions could not have reached to the level where they are today. Whether the collaboration between the banks and the BCs and other aggregators or the insurance companies with the Bancassurance and several other models. But now the question is, the insurance companies have got their own partners, which are the InsurTechs, where perhaps they do not need to enlighten them with what insurance is because they have born and brought up with the idea of insurance itself. Earlier, where the bankers need to learn what insurance is, and that was one of the important collaboration model. So with this, let me ask one basic question to all of you in terms of, private insurance began with the collaboration model itself, bank partnerships. So how has this collaboration model shaped up now? Because we have bankers, we have insurance companies here. And how do you see it's happening right now? Because we have had a great growth. In fact, Bancassurance model contributed to 25% of premium for the insurance companies. So what is the current state? Do you see the Bancassurance is going at the same level where it is? Or the emerging partners, maybe InsurTech or the other aggregators are also, taking over and joining the same pie? And I will start with you, Manish. I'm sorry, Maneesh, yeah.
Hi, hey, thanks for inviting, first of all. I think bank insurance has been now for about, 2 decades, and we've all evolved. Insurance primarily has been a push product, as we have heard others also. It was always, being pushed to the clients. And like it or not, like somewhere banks were blamed for it. But I think a lot has changed in the last decade or so, especially with the advent of so much of social media and digital. Today, clients are that much more educated about bank insurance. Gone are the days when you had to read a newspaper to understand. Today, all you need to do is Google and you will find a comparison between insurance, products. It's so simple to do that today. Nobody thought about in the insurance industry, from the insurance manufacturers, about TAT. Today, people are talking about I can issue the policy within a few minutes. So I think the entire industry has gone through a massive change as far as customer orientation is concerned. And one more critical point is earlier everything was being sold through pen and paper model. We see that today in the mutual fund industry that majority of the sales, 90-95%, are happening through an online model. And that is started to happen in the space of insurance as well. And one of the reasons for that is, I think, the InsurTech, who is, if I may call them, the middle layer, which is really adding that value to the entire ecosystem of possibly bringing insurance closer to the clients.
Noted your points, Manish. That was from the bank's perspective. Anup, what do you think, being an insurer, how this whole partnership model is shaping up?
So, thanks for having me over. See, banks have been a very, very important part of the life insurance penetration. While you said 20% of the gross premium, what life insurance really measures is individual AP. Banks have contributed almost 58% of premium last financial year. And it's one of the sort of dominant channels for insurance penetrations. I think banks have done an extremely good job of playing a very important part of portfolio balancing of consumers. I certainly respect the role of mutual funds, direct equities, structured products. Life insurance is an integral part of portfolio balancing for consumers. And banks have played a very big role in that. And I think the point that we were hearing about making India fully secure, I think banks will play a predominant role there. One of the things the banks have done very well is banks have not just stayed traditional to branch banking models. They've moved to reverse bank, telemarketing, call center-based operations. I think the banks are now making sure every consumer which is in the banking circle is covered for insurance. And what banks have also done is made insurers innovate on products, technology, my point that Maneesh mentioned about issuing policies in minutes. I think thanks to the infrastructure, both of the banks, the manufacturer and the InsurTechs, the innovation, and one of the things that life insurance suffers is not just about being push, but also being complex and tedious. Right now, manufacturers are moving to products which are simplified, where they're giving you tax-adjusted returns of almost 10% for 30 years. They're giving you policies in 30 minutes. They are giving you ease of onboarding by integrating with, whether it's CIBIL, whether it's EKYC, whether it's risk management scores. All of that is now making insurance from traditionally being a push to being a great product proposition for consumers. So I see banks playing a phenomenal role on that, and InsurTechs, both on risk model, operating models, as well as on consumer onboarding, have been a phenomenal partner for us.
Sure. So, Saurabh, let me bring you here. And, what I have also seen, I will slightly tweak the question, in the collaboration specifically bring the investments and the wealth tech angle. Because we are seeing a great rally over there. Now the banks or the insurance companies are also more interested in selling the wealth tech or investment products. How do you see that collaboration shaping up? Do you see that there is a huge demand for the investment products generated or manufactured by the insurance companies? How is it happening there?
Yeah, thanks, Amol, and thank you very much to everyone for having me here. So, each of these products, they form a part of the, financial offering that clients have. So whether it is investment product like mutual funds or I'll take the example of mutual funds, right? That's a classic one. Or even if you look at, exchange traded products like bonds or equities. Or the third one is you look at insurance products. Insurance products actually fulfill a very unique need. And within insurance, there are different types of products, right? So it's not a broad brush. So if we look at individual clients, and I would look at more protection or let's say, for example, health insurance. So these are clear client needs. So they specifically serve particular needs. Then the other category is investment products, which could be, let's say, a unit-linked plan, or it could be a traditional product and so on. And they have their own place as well, which clients look at because they are long-term in nature. They come with various benefits. It could be benefits of allocation. It could be benefits of rebalancing without tax implications. It could also be benefits of, for example, the kind of expense that the product has, the kind of, long-term corpus that you can build. And they encourage long-term investing. So there are those benefits that are there, and clients have historically, like for example, for a bank like ours, which has a lot of affluent clients, and that's our primary target market, we see that as a big play.
Jagadish, from your end, how has been the demand? Because you're operating in a very different area, not a typical bank, not a typical insurance, but a micro lending, and your customers could be from a different background. So how do you see this collaboration between whole institutions paying out for you? Do you see the demand specifically for the small ticket products, or do you see the maybe tier 2, tier 3 side people also look at the insurance or the investment products?
Thanks, Amol. First of all, thanks for having me on this panel. I represent I work with customers who are in rural India, which is 70% of India, and today that's around 17 lakh households. And the industry that I work with, microfinance and rural finance industry, works with almost 50% of this base. Around 7 crore customers are serviced by this segment, by NBFCs and banks and microfinance organizations working in that space. Now, if you go back 10 years back, hardly any of them were covered by insurance. Right? Insurance had to be hard sold. You had to explain why the cost was necessary. But over the last 10 years of experience, customers have seen the fact that this is actually reduces their risk, and the experience with the better pricing, simpler products, and quicker claim process. All of this has made them understand that insurance is actually very useful to them. And today it's not really difficult to sell insurance to this segment of customers. But ultimately, in this space, if you look at an insurer, they don't have the relationship or they don't have the access to these customers. right? Not in the past, not currently, and not likely in the near future, because they are very likely to be less digital, or even if they are using digital, they are less likely to actually transact digitally. So the tier 4, 5, 6, the segments where majority of the population lives in population below 20,000, the geographical limitation makes it very difficult for a insurer to set up a distribution directly or to reach them digitally. So that's where the role of, especially in the hinterlands of India, where, like as I said, 70% population live, the role of the intermediaries like us is extremely crucial, because we are the only link, and only fourth link in the foreseeable future. So we have the trust, because already we are working in the financial space with these customers. The trust is there, the relationships are there, and the understanding of the customer needs is already existing. So what's remaining is actually the closure of the understanding, selling the product, and making sure the process is seamless. I think that's the execution part is where I think the InsurTech has played a very significant role. Like at the small ticket size, large volume, it's extremely important to keep both the selling process and the claim process very simple and a very low error, quick TAT and low error model. And that's where I think InsurTechs have really played a very important role, without which, I think without technology, the cost of the product would be much higher and the efficiency of the product would be much lower.
Yeah, I mean, it's quite notable that the intermediaries have obviously played a major role, because insurance companies cannot just go to a tier 2, tier 3 cities and open their branches. It has its own challenges. So let me bring Sanjiv here, and let me learn from you in terms of the pain point or the challenges. You may have a different problems because perhaps you have not floated any insurance company yet. If you have any plans, please let us know. We'll file a story immediately. But because the good part is the companies like HDFC and others have benefits because the branches are owned by the parent company itself. So when it comes to the integration, maybe you will have a partnership with a couple of insurance companies, right? So what actually goes, what are the major challenges in terms of the business operations, conflict of interest, control over product, because ultimately you have to train your branch managers, branch officers to sell those products. How does it happen, and what are the challenges that you face specifically in the collaborations between insurance companies?
Thank you, Amol. Just when I thought I'll just listen to everybody and just go very enriched, thanks for having my turn, and thank you, Surjendu, for having me here. I think a lot of beautiful points came out from all my co-panelists. Collaboration, and we mentioned collaboration, Anup spoke about the huge growth that Bancassurance has seen. I'll just touch upon give my couple of cents on that, and then come to the challenges. For a collaboration to work, there are three partners in this process, right? There is a customer, there is the distributor, which is the bank, and there is the insurer. I firmly believe that for any collaboration, any partnership to work, all three entities have to go home happy, saying that I have got my share of the deal. What's there for the customer? The customer, when he looks at a bank, it evokes trust. Second, it says that I will get an advice from somebody who's financially knowledgeable and qualified. Third, I will get a view of my entire finances and where the whole insurance fits into my overall financial planning. It takes care of my short-term needs, long-term needs, because bank actually carries a bouquet of products, not just insurance. It has other wealth management products. For a bank, one very clear this thing is to make yourself as a one-stop financial shop for your customer. Because gone are the days when you could have retained and kept your customers happy and let them keep coming back to you just to do certain transactions, like doing a DD or making some payments or doing a bill pay. Those days are gone. That doesn't command loyalty. Just when RBL offers 1% higher on savings rate, my customers can start thinking about RBL more than me. How do I ensure that my customers stick with me? So if I give him an overall financial, a one-stop shop where he doesn't have to worry about whether it is loans, whether it is cards, whether it is bill payments, whether it is transaction banking, whether it is trade, whether it is Forex, whether it is wealth management, he is looking at me. And the endeavor for most banks, none of us are very different from each other, is to see how do I offer this entire bouquet. And to offer an entire bouquet, you need to know your customers well. because that's when you'll realize what fits whom and how. And that's where banks have a significant advantage with vis-a-vis any other traditional insurance distribution model, whether it's agents or brokers, because we have complete view. Second, it is a capital-free income for us. It's as against fund-based income, it's a fee-based income for the bank, which does not put its capital at risk at all. Third, it allows my customers to stick with me even when I get something wrong on my core banking sometime. If I have a health insurance, a life insurance, a mutual fund, my customers will find it a little difficult to leave me, even if my one branch does some screw up, sorry for the word, but some screw up on some transaction of his. So it allows me to kind of keep the customers. For the insurers, the insurance company, it actually is a very cost-efficient model to distribute. And you get an access to a large set of customers without opening so many branches, hiring so many agents, etc. The scalability is now very high because of the fact that the banks are acquiring more and more customers. So you are riding on a train which is moving fast rather than trying to manufacture your own train and want to pump it up and take it to speed. And that's where this collaboration works extremely well. I don't think this collaboration will come to a halt or slow down its pace over the next 5 to 7 years, because fundamentally all these objectives won't change. When it comes to the challenges, and when you are a distributor and you're a bank, the first thing that I talked about is the trust. I cannot risk that trust that I have between me and my customer because of a certain category of product or certain product that I want to sell. So first thing is to ensure that your product suite that you take from the insurers goes through a complete microscope. And the microscope that I say is that if I am willing to buy it, because I have worked in insurance for 15 years, I know what works, what is good and what is not so good. So I am very clear that we will not sell or offer products to our sales team, which does not gel well with my customers. I will not, if I am not willing to buy, I don't want to sell it. Second, how do I ensure that my sales practices, because the biggest challenge is to manage that where the rubber meets the road, because we have attrition, financial services is going through attrition, the frontline sales team, how do you ensure that he gets it right? And there you have to put in the process with the help of the insurer, where the customer is aware and not depending on this guy to tell him all the features and benefits. There is a process where the customer is reading or being told, and after that he's giving his consent. So you have to manage that process well. There has to be very strict staff governance matrix that if you get it wrong, your job is in danger as a sales guy. The biggest challenge always is that, will it get positioned against an FD, particularly when you are selling a life insurance product, or being misled on the term of the policy. And that has to be set through with the processes. The customer again looks at convenience and says that, boss, can I buy this easily? I know I want to buy it, but can I buy this easily? And which is where the integration challenges, which you spoke about, Amol, you have to be ready before you go out to the market. So we have gone into open architecture. Right now we have 6 partners across life and general. We have added 3 more health. There is a 3-month project which we work where it is completely integration work between the insurers and us. Only when we are completely ready is when we will go to the market, is the philosophy that we believe in. And some of these challenges can be dealt well if you are over ready, rather than just trying to meet it once you reach there. Thank you.
Sure. A detailed one, Sanjiv. So I hope all of you observed that, here the manufacturer is only one. Rest of them are the intermediaries. So the number of the intermediaries are actually high. And that's where the penetration is also kind of getting some boost. So Anup, let me come back to you now. And considering the new, intermediaries like InsurTechs are coming up into the market, like Saurabh mentioned, even wealth tech insurance, there is a demand for investment, and wealth tech insurance companies are also getting into this space. How do you see this collaboration model scaling up? What kind of opportunities do you see as an insurance company? Because initially, the insurance companies which had a bank partner of their own benefited a lot. and perhaps the companies like you did not get that benefit. So how do you see the collaboration now with digital partners, InsurTech companies, wealth tech companies shaping up and giving you more business and benefits?
Thank you, Amol, for the question. While I'm in a minority on the stage from a manufacturer point of view, I hope I don't find minority in the agreement on approach. See, one of the biggest things, as Sanjiv alluded towards, as long as there's a win-win solution in place for the consumer, for the manufacturer, for the distributor, you will find that India is ready to understand elements of how to make money out of money. It's been over 2 decades that India has learned how to make money, but how to make their money, generate money while they are sleeping is not a skill India understands. And unfortunately, our education system doesn't even allude towards that. Your question around fintechs and wealth-techs, in my view, I think there are a lot of initial wins that we see that are happening with risk models which have allowed onboarding to be simplified. Because in my view, insurance arbitrages are very different from what other product arbitrages. For instance, on a term product, I will take 10,000 rupees and I will insure him for 10 crore. Hypothetically, it might be for a younger age, might be 10, might be elder age, might be 1 crore. The arbitrage is against me. I'll end up losing a lot more if I take a bagged risk. A lot of models around collaboration, around digital scoring models, for instance, the Paytm model gives me a Paytm score, allows me to validate the consumer veracity in terms of existence and that he's not buying it for insurance as an interest, but he's consuming other products and he's, by the way, taking a sachet insurance. The model around wealth-techs, okay, clearly there are great models which are built around, whether it's the grow model, whether the individual model. They are right now majorly anchored around mutual funds, but I see a lot of interest for them to look at sachet insurance. A lot of them are looking at ULIPs, and I can tell you for a matter of fact, I don't want to start a debate between ULIPs versus mutual funds, but I can guarantee you the new age ULIPs, the 4th gen ULIPs, their cost structures are lower than direct mutual funds, and I can, in any technical forum, get onto that debate. And ULIPs also have a fund-on-fund option, right? You don't have an entry-exit option. Wealth-techs are now experimenting on making sure ULIPs through the SIP route becomes a big part of getting retail wealth moving into categories of equity markets and debt markets. I think there is a need for us to do one thing principally. If you want to participate with the wealth-techs of the world, the fintechs of the world, you have to be digital native. You cannot be physical in your mind and digital in your operational thinking. They are two different worlds. A lot of manufacturers, and I can tell you, we are the youngest life insurance company, at least till a quarter back now, the 3 people have got insurance. We were born digital. So for us, I can give you 2 stated examples. When the whole industry in COVID went down, we were up 20% because we were digitally born. Everything, from our digital advisory to our learning platform to our onboarding platform, 100% digital. We were 100% onboarded digitally even before COVID happened. Today, the wealth-techs require a very simplified product proposition, a full digital integrated onboarding process, which almost makes it as simple as consuming a credit card or consuming a mutual fund or consuming a loan. It has got to be that simple. Manufacturers need to do something very differently on products. Insurance has been known to be push and complex because the products are not simple. That innovation on product is, in my view, the most win-win that a manufacturer can bring to a platform like banks and wealth-techs for them to explore this market and take it to making India secure fully.
Sure. So I think the complex part, which I think we partly discussed in the first of our conversations as well. In fact, when I started reporting on insurance, I still remember I used to have my dictionary on the desk. Most of the times I didn't understand the words reputation and, all those things. And I think one of the insurance company had in fact issued a small dictionary also. So imagine how complex it was, to understand. So Saurabh, let me come back to you, and my question is now very important for you. Considering you are handling the wealth management, when you go to the customers, do they look at insurance more or maybe the other products, investment products like mutual fund or something? Because there is always a comparison between, insurance and a mutual fund. So as an intermediary, will you go for insurance or mutual fund? How do you actually maintain that balance?
So let me make a couple of points, I think, which are a little bit. So one, I will just step back and, mention one thing which I think a lot of times doesn't get the credit that it deserves, is that the ecosystem in India, in each of the products, it is done so well simply because the regulator has been very progressive, right? So whether you look at SEBI and the kind of evolution that mutual funds, I'm just taking simple examples rather than more complex products, right? Similarly, again, I'm very excited, we as an organization, and I'm personally very excited about the kind of progressive thought leadership that the, insurance regulator, has shown, and the kind of intent and vision that they have for our country, right, for 2047, and various spate of regulations that are coming, which I think will make the whole ecosystem very vibrant. I also want to I'll just make basically a few key points. One other point I want to make is that, and the topic of the session is insurance, InsurTech and banks. And I think Sanjiv mentioned that there is a triumvirate between the client, the insurance company, and the distributor. I would add InsurTech to that. So maybe it's more like, the three of them have to come together to be able to, deliver a seamless experience and variety of experiences, right? So I think as the architecture becomes more and more open, one of the challenges for banks is how do you really open that completely, and InsurTechs have a huge role to play in terms of the way they can do it. Again, going back to the earlier point, like for example, I'm really excited about the kind of aggregator platforms, etc., available, and broadly, not just only for insurance. Like for example, you see that on the fund side, that's coming on insurance as well. I would say these are watershed changes. These are landmark changes. They will really evolve and develop the industry, right? Coming back specifically to your question, Amol, right, on what you said is that, for example, when you go to a client, what do you, do you look at insurance versus investments? I think the answer lies more, I think Sanjiv touched upon the point that when we go as a bank, for example, I will go to meet a client, I will look at the overall financial position of the client, right? They have an asset allocation, or they have various products, so they may have fixed deposits, they may have, for example, they may have, let's say, SIPs running, they will have an investment portfolio, they will have specific insurance needs, right? So someone may need protection, someone may need health, those are, to my mind, fundamental needs. And over and above that, then, you first serve those needs, and then you build on it. And then you see what is the need of the client, and like, for example, for legacy. So there are certain products within insurance which actually are not replaceable, or there is no substitute for that product in investments. So actually, when you go and meet a client, you try and understand the client's need and then offer the right product. That's the endeavor. Now, how do we do that? That itself is a challenge, right? How do you train a large sales organization to be able to understand and do that job? The client also has to be willing to be able to have that dialogue and all, but that I'm leaving those aside. But at a conceptual level, that's the approach. And I think Sanjiv also mentioned, he made many good points actually. So one of the things he also said is that you cannot have only few products. You need to have a broader offering. So once you have a broader offering, you have the ability to go to a client and then advise or offer whatever fits the need the best, keeping the overall relationship in mind. That's the advantage a bank has. I have a larger view of the client's relationship with the bank. Thanks.
Absolutely, Saurabh. In fact, very meaningful one. So, Maneesh, let me come back to you. Recently, I had a conversation with the SBI chairman at Global FinTech Festival, and I tried to learn more from him in terms of how SBI YONO is shaping up. And what he said is, his quarterly revenue is 100 crore. specifically from SBI, you know, that comes from only the fees income. I mean, SBI is gigantic, no doubt about it, and fees income can include so many parts. But for banks also, selling insurance gives a substantial revenue, substantial profit, because there is a huge commission there. So at RBL, and in fact, when you go to the branch managers always ask you whether you want to buy insurance or some other products. Is it going to be a substantial business for you going ahead also, Maneesh? And what are you going to do maybe to increase that business? How are you going to develop your partnerships more with insurance companies? And how do you see the whole business shaping up, maybe a different level going ahead?
Hi. You know, my colleagues have tried to answer that. I think all products have their own space under the sun. And somebody mentioned that when you go to a branch, and we were counting yesterday, we have about 28 products that a branch manager or a frontline person has to sell. 28 products. And for him to actually remember the intricacies of all these products is not an easy job. We always believe that the RM at the ground level is a supercomputer who can actually remember so many products and will be able to rattle off all the features and benefits of everything. So that's one point. And I think that's where technology comes into play, and I'll talk about that in a while. Does insurance form an important portfolio for us at RBL Bank or any other bank? The answer is clearly a yes. Because there is so much need. I mean, look at the penetration in the country that we have. And you may talk about an ultra HNI or an HNI. He may be insured. But even when we talk to them, they may have bought a policy 10 years back. His income would have been in X. Today his income is possibly 2X or 3X. Is he insured for his income today? The answer is clearly no. One of the things when I talk to my HNI team on the health insurance side, they say, sir, every person we go to is insured. I said, fantastic. I'm sure all these people have bought insurance. But at what is the sum insured today? Sir, only 5 lakhs or only 10 lakhs. 10 lakhs or 5 lakhs in today's day and age, because he bought a policy about 10 years back. 10 years back, 10 lakhs was good enough. Is it good enough today? The answer is no. So a lot of upsell will continue to happen in the industry. That's one thing. So clearly, I think there is a huge opportunity for us to keep growing the insurance pie within the banks as well. At the same time, keeping in mind that one does not cross the Lakshman Rekha, because it's very easy to cross. As you said, if you go to a branch manager, he says insurance khareed lo. So we need to be careful of that. And as a bank, we are very, very mindful of it. We play a huge part in what we call our scorecards on what's the renewal ratio, what's your persistency, what's your 13-month renewals. So a huge focus is kept there. And if we find some mishaps, we do rap on the knuckles very clearly. And I think coming back to the part of, I also head a little bit of the fintech side in the bank. I have a part of my portfolio. And I've seen them, whether it's in the payment space, whether in the wealth space, and now of late in the insurance space, all these players have identified a need and trying to really plug that need for all of us. Similarly, InsurTech. I mean, he spoke about signing up a new partnership. It can be a 3 to 6 month process to integrate APIs, blah, 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 and can be very, very painful for a bank. Does the bank IT department have that kind of a bandwidth? The answer may be yes and no. Or it may get delayed because there are tons and tons of priorities on your core banking, trade and Forex solution and so on. Right. I think that's where the InsurTech plays a critical role in bridging the gap. And that's, I think, between the consumer, insurance, the banks, I think the InsurTech will continue to play a very, very critical role. And also in helping sell to the consumer. Back to the point, 28 are the products. Then you come to insurance. Life insurance, the amount of life insurance products that you have, he possibly cannot remember. I think a solution like an InsurTech can help educate him, make a comparison to the client, and let the then client decide between what he can offer.
Sure. Noted your points, Maneesh. So Sanjiv and Jagadish, I have one common question to both of you, and I want you to answer this, and after this, I will come to you, friends. If you have any specific questions, please be ready with that. So Sanjiv and Jagadish, I will start with you, Sanjiv. The simple question is, considering the rise of the bank assurance, considering there is a demand of the intermediaries, now will you dictate rules to the insurance companies, forget what you have crafted, craft this product for my customers? Will you still go for hyper personalization or maybe personalization, because now you know your customer well, and dictate rules to the insurance companies that I do not want your ULIP, but maybe a synchronized product according to the needs of my customers, because the customers for both of you are very different.
So I will not use the word dictate, it sounds a little autocratic. But I would definitely forge and take my partnership ahead, because see, insurance is a very long-term game. By the nature of its business, it's not an industry where you can operate for 3 years, 5 years, 7 years and shut shop. It's not possible. You have to be planning 100 years, if not more. And hence, most insurance companies across life, health, general, their top management, board, all of them, I see very aligned to that thought that I'm here for the long run. I'm not here to make some quick bucks and go away. The shareholders are aligned to that thought as well. And hence, any partnership where you are showing a long-term path with a very clear short-term approach works. And the bigger the company is, the more they are, the bigger their franchise is, the bigger brand they have built, the more buy-in I get. What we do, and I can tell you our experience, is that for every product, there is a co-creation, whether it is on the life side, health side, general side. So it's a co-creation. I have a very strong product team, which actually is from the insurance industry. They are not bankers. They are hired, including me, they were hired because we understand insurance. We worked on the product side. We have sold those products. We know what is right and what is not right with those products. We also know, because of this view that Maneesh also alluded, Saurabh alluded, I also know how does it, if it is my HNI customer, what is it that he needs today? And you have to keep in mind the interest rate of the economy. You have to keep in mind the global economy. Today, I also offer products where the customer can globally invest. So where do I get my gaps filled up with my insurance offering so that it does not cannibalize each other? Point number one. Second, it's complementary to each other. And hence, there is co-creation as a part of the model. It is not dictation, or it is not they enforcing on me or we enforcing on them. There is very clear co-creation. Yes, there are products which may have been there in their shop for a long time. I have the right to say I will not pick up those products and sell. That right we enforce all the time.
Sure, Sanjiv. Jagadish.
Yeah, I agree with what my colleague said. So it's not really dictating, but I think what is more relevant is strong engagement, right? Understanding, because you see the customer's perspective very closely, and it's important that the insurance company and you co-create products and work on engage to make your products more relevant. Especially in the segment that I operate in, where sustainable livelihoods is the key theme. Things like climate, impact of climate is a very, very high. For us, let's say in Mumbai or Hyderabad, a cyclone means disturbance. You're watching TV at home for the next 2 days. But in a rural household, it would actually mean your next 1 year's income is gone because your crops are destroyed and you could have an impact on your cattle. And there's a lot of significant risk that carries into the livelihood of the household. So unfortunately, we don't still have, we are nowhere close to creating or co-creating products which meet the mass of India. So I think there's still a lot of gray areas, a lot of open spaces. While we have a lot of the work that's happened, at least in the segment I work with, is more on improving the workflows and the removing the pain points of the products, but not really filling in some of these open spaces. So,
sure, noted your points, Jagadish. Can we have any questions? Anybody has any question? Yes. Request you to please be specific with your question.
Hi, good afternoon, everyone.
Yes.
Is it audible?
Yes, please go ahead.
This is Inderjeet here from Niva Bupa. My question is specifically to Anup. See, what we have seen, a very silent revolution happening in the last 6-7 decades, in terms of longevity across the globe and, of course, in India as well. So in that context, when LIC started, right, we called it life insurance because, that is what we started, people, longevity was not there. But now with the changes now, the shift is from a life insurance to a living insurance, right? But people live, 80, 90, even 100 years as well. So how are you addressing this challenge, or I would say an opportunity, as a manufacturer and along with the distributors?
Thank you. That's an interesting question. I think, see, clearly there is life expectancy in India is now at 78 for women, at 76 for men. It's up from 29% over the last decade. Significant shift. And I think India will have to prepare itself to having expectation that you will have 20, 25 years post-retirement livelihood. Unfortunately, India doesn't have a very strong system around pension, stroke, retirement corpuses, but there are several offerings that products can do, and I can tell you one specific around life insurance, and I was alluding to it earlier. It's unfortunate that life insurance has had a very bad reputation thanks to some of the work that happened in pre-10, and the regulator has regulated a lot of things around product charges and structures around it. I can give you a guarantee. I'll make you two examples around retirement, and I've done it for myself, so I can tell you, and I'm a certified financial planner. I can give you a product on life insurance which can give you 10, 20, 30, 40 years ahead, tax adjusted, under 5 lakhs, a 10% guaranteed IRR. And I can challenge you that as much of economics as I understand, most markets globally, and we are now top 5, except the exception of last 1 year, if you looked at global markets for last 10, 20, 30 years, interest rates in most mature markets which are higher than us in GDP, interest rates have been in the single digits of 2, 3, 4%. If assume inflation is at 5%, 6%, 7%, if I give you a tax adjusted product, giving you a 10% IRR for next 30 years, that only life insurance can give you. There is no other financial products can give you tax adjusted returns for 30, 40 years. There is no instrument. There is an IP that life insurance understands better than most financial product organization, is to interest rate hedge, the asset liability hedge for long-term assets, which life insurance can do, apart from what my friend alluded towards is the legacy planning and it all. But retirement, I can guarantee you there aren't many products in the market which can hedge your 30, 40 years, which is an average 40-year guy trying to plan for retirement. There ain't any product. Yes, and I'm always very conscious that you cannot hedge your retirement with one product. You have to have fixed income as a permanent part because it's risking your retirement is not a thing that you want to do. Depend on your children and depend on somebody to take care of you. You plan your retirement to fixed income. You also have an equity exposure. You can take debt that are structure. You can take structured products, which banks offer through other manufacturers. But there are options. Fixed income, life insurance, hands down, is the best option for Indian people to plan their retirement, which is guaranteed, no ifs, no buts, no asterisks. It's giving to you a fixed IRR, 30, 40 years. That's my answer to your short.
Sure, Anup. Any other question? Yes, where are you? Yes, please, go ahead. Can you have a mic there on the first table?
Hello everyone. My name is Anurag Sonpali. Sir, I've been watching a lot of series from Sandeep Maheshwari, the Motivator, and Anku Wariko, and also from Rahul Kelodia, also from Varun Dhawan, the financial analyst. Now Varun or the Vivek Mishani talks about you put your money into something called passive investing, right? Index funds and the next index funds. So, it has been prudent enough to say that our Sensex is going to give a return of 15 plus minus 3% for the index funds, and the next Nifty 50 will give a return of 18% plus minus 6%. These data are available over the internet as well. You can do a WhatsApp, you can do a YouTube. So number one, my query is that somebody telling, or Anup sir telling that, you 10%, I'll guarantee you nobody can beat it. So it's well known in the industry that, definitely the index funds are beating it.
Can you come to the question quickly?
So index funds are beating it, number one. So let's be honest with our customers, saying that though we have a product, if you want to have an insurance element incorporated in it, so please go ahead with it. But in terms of the investment component, don't put an insurance component. Don't put an insurance.
May I know your question, please, if you don't mind?
I don't think you are asking a question. You're making a comment, right?
Yeah, I'm making a comment on the Anup sir. Okay. Yeah. Second thing is that Sandeep Maheshwari has just released a video also that there's a new South Age Bank which gives an XIR return, XIR, not even IRR, XIR return of 30%. I won't disclose the bank, it's up to the people here, because I'm a financial analyst to determine it out. Yeah, so they just wanted to make a comment, yeah. Because see, I have been into insurance industry from the last 20 years.
Okay.
And I've seen that, I've been also befooled by people from ICICI Prudential earlier, purchasing a ULIP plan which gave me a return of just over 8% over the next 3 years, and then finally I have to surrender the policy. Thank you so much.
Appreciate your comment, but we were just looking for some specific questions because the time is very, very limited. Can we have one last question, maybe? Question only, please be specific. Yeah, the mic on the first table, please. Yeah.
Thank you. This is Amit Kashyap from JB Boda Insurance and Reinsurance Broking. And this is primarily the curiosity side to the bankers on the floor. It's like what we see the InsurTech is majorly helping the insurance company to, provide a seamless experience to the retail customer base in large, like motor insurance, health, and they are cutting across the intermediaries and to, have the profitability and other experiences. So what role the bankers will have into the, bancassurance channels onto the popular products, the one that is mandatory also, because that is being, bought very quickly over the, online channels like Policy Bazaar or e-commerce. So what is the thought of the bankers on that?
Maneesh, do you want to take that?
I think all bankers out here and everybody in the room, there is a lot of captive audience that we have. So Policy Bazaar or any other such players, aggregators may be trying to, of course, sell insurance to customers at large. But there is a captive audience to whom a multiple range of products can be actually offered, and insurance is one of them. To your point on insurance, InsurTech, I think they bridge the big gap between, so let me put it this way. Tomorrow a new product is launched by a health or an insurance company which I am partnering with. If I want to sell that online seamlessly through my platforms, it's going to be a huge onerous task in terms of APIs, in terms of bridging the gap, in terms of InfoSec and everything. And I think that is the solution that the InsurTech brings to the table, of bridging that gap clearly. I don't have to bother about building the APIs. I'm going to be in my core banking and in my core job of distributing insurance products and leave the technology to somebody else. I think that's the moot point of InsurTech. I don't think so they take away the job of selling from us. They may make a job, may make, and definitely will make our life simpler.
I just want to add on maybe a couple of points to what Maneesh said. See, for example, if you were to compare the ecosystem, the financial ecosystem, right? Just to give you an example, if I'm selling a mutual fund, I can sell of any company, I just integrate with 2 RTAs. And the RTAs in turn take care of everything, right? I don't have to do anything. However, in a more open architecture, the way, for example, IRDA has been, promoting, as I partner with more insurance companies, and keep in mind the second specific, attribute of an insurance product, it is long-term in nature. Given that it is more long-term in nature, there could be a lot of things like, for example, servicing, there could be renewal, there could be many other aspects. Now, either each bank does its own integration with each insurance company, or you have an InsurTech company which really helps you do that in a very seamless manner, which, for example, and that's why I give you a comparison of another industry, right, within the financial ecosystem, which has the integration already built in, right? Here, if I have to, let's say, compete as a bank, let's say with a Policy Bazaar or something, either I have to build it all by myself and show the comparison of the product, or I could maybe rely on an InsurTech company.
Sure, I think I will stop here, but just one quick question to Anup, very, very quickly, in few seconds, because the time is up. Intermediaries are there. We have large number of financial institutions working as an intermediaries for insurance companies. Will you also go ahead and see the greater scope of non-financial intermediaries like Swiggy, Zomato, Ola, Uber, going ahead and, issuing maybe a Swiggy delivery boy will come with, hey, take this insurance policy as well.
So I'll try and keep it brief. I think insurance subject is a long-term product, and it is a product which services a real life need. I certainly believe there's a democratization of insurance distribution that will happen, but it requires today a mandatory IC38 training. It requires either an SP or an employee to be deemed certified and sell. I see some possibilities of accessing differential insurances, opportunity on distribution. But I think one of the biggest things we have to remember, we have a moral and an ethical responsibility of making sure the right product is sold to the right customer. I think for us, all of us come from a latent purpose of saying that we have been given a chance to make India help make money, they make money, and help them live a risk-free life. Having said that, if we can find models of training, compliance, to make sure that the right matching of consumer need to product is done through right channels, I think that will happen. Fortunately, our regulator is very, very pro. I think we've seen the regulations over the last year and a half have been very pro to allowing democratization both on the products and on the distribution side. While today it's not possible on the LI side, GI has done some work on Ola, having your rides insured. I see life being a slightly behind the curve on that, but as I always say, I remain very, very optimistic about India and the fact that India is uninsured, we will find such innovations happening here.
Sure, sure. If I'm not wrong, I think Future generally had tried something because they had Big Bazaar as a market channel.
I used to run that model 12 years back, Mall Assurance.
I don't know how successful that was, but that was a little different or unusual case study.
It is a model which has worked well in the South Asian markets. It works well in the China and the Thailand, Malaysia markets. I think those innovations will happen. You just need to innovate the entire journey from front to back, and you should see it happening more.
Sure, I will stop here. And since I mentioned about Swiggy and Zomato, I think we all are hungry. The lunch break is already there now after this session. So, but thank you so much for listening to us very patiently. And thank you so much for writing absolute meaningful thoughts here. Thank you so much.